If you have been living outside India for a few years and there's any chance you might move back home one day, how much time have you actually spent thinking about how that move will affect your taxes? Most people I ask go quiet for a second. And then they say something like, I guess my CA will figure it out when the time comes. That's a fair answer. It's also the reason a lot of people end up paying more tax than they had to, sometimes a lot more. So let me share something most people don't know. When you move back to India after spending several years abroad, the country actually gives you a small window of time where some of your foreign income is treated differently. It's a real benefit. It's written into the tax law. It's been there for years, but almost nobody talks about it. Not your travel agent, not your relocation consultant, not your relatives, not even most accountants, unless you specifically ask. By the time most ex-NRIs learn about this window, it's already gone. And whatever planning they could have done in those 2 or 3 years, they did. That's what this video is about. The technical name for this window is RNOR, which stands for Resident but Not Ordinarily Resident. I know, sounds funny, right? Here's what it actually means in plain English. When you move back to India after living abroad for several years, you don't immediately become a full Indian tax resident. There's a transition period in between, depending on how long you have been away and how many days you have spent in India after returning. This transition can last roughly 2 to 3 financial years. During this period, your situation is special. There's a simple way to think about it. While you are in this window, most income that comes from outside India is treated more gently by the Indian tax system. The interest sitting in your foreign bank account, the growth in your foreign investments, the income from assets you still own abroad. Generally, the Indian tax system doesn't reach for those assets during this window. Once the window closes, your status changes. After that point, India looks at your total income from anywhere in the world and starts taxing it in the same way it would tax any other full-time resident. That shift happens automatically, whether you are prepared for it or not. Now you might be thinking this sounds technical. Why should I care? Here is a real example. Say you have worked abroad for 10 years. Over those 10 years, you accumulated some shares of a company, maybe through your employer, maybe on your own. The shares have grown in the value. Now you move back to India. If you do nothing during this transition window, those shares quietly carry all 10 years of growth with them into your new Indian tax life. And when you eventually decide to sell, that growth becomes relevant in ways you may not have planned for. The transition window gives you time to think this through with a qualified advisor. Time to look at what you own, where you own it, and what makes sense for someone in your situation. It's the same with retirement accounts you opened abroad. Same with certain types of foreign deposits. Same with how your bank accounts in India get reclassified once you return. These are not tricks. These are real provisions in the Indian tax law that exist precisely because the government understands that people coming back need a transition period. The problem is most people never use this transition. Let me make it even simpler. Think back to when you were in college. You would come home for winter break. The first 2 or 3 days were beautiful. Amma made all your favorite things. Nobody asked you to do anything. You woke up late. Tea came to your bed. You were treated like a guest in your own house. And then around day 3 or 4, things quietly changed. The morning tea stopped arriving on its own. Amma called you to help in the kitchen. Appa asked you when you were going to the bank to get something done. Suddenly, there were chores. Suddenly, you were back to being a regular member of the household. The honeymoon period had ended. Nobody announced it. No formal moment. It just happened. Moving back to India works in a similar way. For the first 2 years or 3 years after your return, the Indian tax system treats you a little differently. There's quite a honeymoon period. Your foreign income gets some breathing space. The rules are a little softer on the money you've built up abroad. And then Just like the home during the break, the honeymoon quietly ends. Nobody sends you a letter. There's no announcement. One financial year you're in the transition period, the next year you are a full resident. From that point on, the Indian tax system looks at everything you have, anywhere in the world, the same way it looks at any other full-time resident. Most people don't realize this is how it works. They land in India and behave as if they are already a full resident from day one. They miss the honeymoon period entirely, and by the time someone tells them about it, it's already over. Your foreign bank interest now gets looked at by the Indian tax system. Your foreign investments get treated differently. You have to start declaring your assets sitting outside India in your Indian tax return every year. Certain foreign retirement accounts come under specific Indian rules that require one-time choice you can't easily reverse later. If you would have known about all of this earlier, you might have approached things differently. You might have asked different questions. You might have spoken to a qualified cross-border advisor while you still had the time. So, what should you actually do if you're thinking about moving back to India in the next few years? 3 things. None of them are complicated. 1. Just be aware of the transition window's existence. You don't need to become a tax expert. You just need to know that this period is real. Roughly how long it might last for your situation, at what changes when it ends. 2. Find an advisor who actually understands both sides. A regular CA who only deals with people living in India full-time may not know your foreign accounts well. An advisor abroad won't know the Indian rules. You want someone who has worked with returning families before. Someone who can look at both sides together. You can also reach out to communities like Rupee Stories for help from people who have already made the move. 3. Start thinking about this 2 to 3 years before you actually move, not after. Planning works best when you have time. Once you have landed in India and the clock starts on the transition window, your options narrow. This isn't about doing anything aggressive, it's about not being surprised. Most people plan the visible parts of the moving back. The flight, the school admissions, the home setup, the address change. The financial side is the part nobody warns you about. Not because it's unimportant, but because most people in your life have never done what you are about to do. The country gives you a small window to prepare. Whether you use it or not, it's up to you. Just make sure you know it's there.